Well, greetings everyone, and welcome to the Argonaut monthly video covering January 2024. Milei in Davos. Successful investing is often about learning from mistakes, ideally other people's mistakes. The most common mistake last year was assuming that going from a 0% to a 5% interest rate world would cause an economic recession. There were several reasons why a recession didn't happen in 2023. The long and variable lags of monetary policy, the terming out of borrowing from both consumers and corporates, the benefits of higher rates to those with cash balances. It was the banks which lent long and funded short, which were the patsy, not their customers in the real economy. But the biggest factor that investors ignored was the reckless government stimulus all over the Western world, but particularly in the US, which is running at an unprecedented deficit spending of 8% of GDP. This never happened before in peacetime and at a time of full employment, and was not at all what Keynes had in mind in the 1930s when he advocated counter-cyclical government spending on infrastructure projects. This marks a sea change in politics, where the 1980s saw not only a victory for the West against communism, but also for private enterprise against government. For much of the last 40 years, good government involved balancing the books and getting out of the way. This coincided with a 40-year bull market in wealth creation. During January, the new president of Argentina, Javier Milei, traveled to Davos to tell delegates at the World Economic Forum that the West is in danger. Whether they declare themselves openly communist or socialist, social democrat, Christian democrat, neo-Keynesian, progressive, populist, nationalist, or globalist, said Milei, in substance, there are no real differences. They all hold that the state should direct all aspects of the lives of individuals. In other words, there was now an unhealthy political consensus, even amongst the supposedly successful capitalists in Davos, that bigger government was a good thing, based on the idea that only government can solve problems. But on closer examination, it turns out that these are problems caused by government rather than market forces. More government cannot be a solution to problems solved by big government. We continue to be amazed that financial markets are so focused on transitory disinflation and remain so complacent about government fiscal recklessness and the increased power of the state, which has always been an enemy of free enterprise, private capital, and wealth preservation. There are no examples of sustainable, faster economic growth caused by more government, and bigger government creates only bull markets and bureaucracy and misery. Whilst the last 40 years have been an investment golden age, it seems that few market participants are contemplating the consequences of the regime change as articulated in President Milei's warning, where government is much more important, but this has largely negative consequences for investors. January 2024 review. Markets came into 2024 on the back of a strong year-end rally in risk assets, largely because of the Federal Reserve declaring victory on inflation and the prospects in 2024 of up to 7 quarter-point rate cuts. This year has started with small gains in equities and oil, but profit taken in government bonds. The Argonaut Absolute Return Fund made over 5% in January, making positive returns in its long and short book. For details on how we did this, please refer to our January monthly fact sheet. Suez Canal crisis. As many of you will know already, the fund has been bullish on oil tankers, specifically clean product tankers, for most of the last couple of years, based on a politically motivated oil refinery closures in the West, which means that imports need to increase. Trade dislocations caused by Russian sanctions, which further increases demand since Europe is now importing refined product from China, India, and the Middle East rather than Russia, and generous dividends from the companies and manageable industry order books for new supply. January saw an escalation in geopolitical tension in the Red Sea through Houthi rocket and drone attacks on commercial shipping. Whilst we are skeptical about the effect of this on oil prices, we think this Iranian proxy war is not easily resolved and has the potential to cause sustained disruption to Suez Canal transits, which would increase demand for ton mileage and for shipping. If we look at how the conflict has impacted shipping so far, we can see that the main drop-off in Suez transits has so far been in container ships, where volumes are down 90%, as in general, these cargoes are more valuable and costly to insure. We are not invested in container ships since the bull case is wholly reliant on the continuation of the Red Sea conflict. But let's also look at how the conflict has impacted other shipping. First, crude tankers. We can see that transits have halved, but that north-south transits, which are generally Russian crude, have been resilient, presumably because the Russians are allies of Iran and therefore the Houthis. If we look at product and chemical tankers, where we are invested, transits have more than halved, but again impacting south-north transits, which are generally refined product from the Middle East, India, or China being exported into Europe. These ships are being redirected around the Cape of Good Hope, leading to increased demand for ton mileage, even higher industry capacity utilization, and higher day rates for ship owners. It is worth remembering that the Suez Canal was shut in 1956 and again for 8 years between the Six-Day War in 1967 and only reopened in 1975. This is not our base case, but market expectations, assuming that the current situation is easily resolved, look naive. We continue to think that risk-reward in product tankers looks very attractive. Powell Backtracks. The January FOMC saw a return of old hawkish Chairman Powell, presumably having read Argonaut's timely warnings of repeating the mistakes of the 1970s through premature easing, backtracking from his dovish December inflation victory lap and ruling out a March rate cut from the FOMC's base case. Fed fund futures have changed only marginally, going from pricing in 6.5 quarter-point interest rate cuts starting in March to 5.5 starting in June. Somewhat surprisingly, in view of the drawdown in the Fed reverse repo facility, an ongoing source of money market liquidity for Treasury bill issuance to just 500 billion from 2.5 trillion at its peak, Powell said that the Fed will only start talking about the tapering of QT in March. Regional bank Redux. The Fed statement also deleted references to the US banking system being sound and resilient. On the same day, the share price of New York Community Bank, which bought the assets of failed Signature Bank from receivership, fell 40% as it cut its dividend to build regulatory capital and increase loan provisions from 52 million in Q3 to 552 million in Q4, and charge-offs from $24 million to $185 million. Subsequently, Japanese bank Alzora also fell by a third, owing to higher loan loss provisions from its US commercial real estate exposure. The Fed also announced the ending of the generous lender of last resort liquidity facility to commercial banks, the Bank Term Funding Program, the BTFP, on March the 11th. This facility, introduced in March last year, allowed commercial banks to pawn their assets at par rather than market value. The Fed also announced the ending of the free money arbitrage for commercial banks on January the 25th through raising the lending rate on the BTFP from 4.9% to 5.4%, the same rate as banks receive on their pledged collateral. Now, the fund significantly increased its short positions in shaky US financials and regional banks at the end of the month. This was because the bull case on these financials is predicated on Fed easing which may now not happen unless there is first a regional banking crisis. Asset quality, particularly in multifamily and commercial real estate, is deteriorating faster than assumed. Regulatory pressure is building for banks to take provisions and build capital, and the overall liquidity situation in the US banking system and financial markets is deteriorating. The strength of the US economy continues to surprise positively, with first estimates of Q4 GDP of plus 3.3%. That's versus just plus 2% expected. January non-farm payrolls saw 353,000 net new jobs created rather than the 185,000 expected. This was the most in the last 12 months. The Atlanta Fed Q1 real GDP nowcast estimate is currently plus 4.2%, and that's just against estimates of only plus 2% at the start of the year, so a significant re-acceleration of the US economy. And survey data, for example, the ISM service prices paid is also already showing inflationary pressures re-accelerating. Now, an accelerating US economy is not what the market wants to see, since it makes it more difficult for the Fed to deliver rate cuts. It also increases the chances of a liquidity crunch and a further regional banking crisis. So the Fed may eventually get to deliver its pre-presidential election rate cuts, but we suspect only after a mini crisis in the short term.